That premium, of course, is not deductible. It's considered a medical expense. And so to the extent of some statutory amounts, which vary by age range and go up indexed like some other many federal numbers these days, to the extent of those indexed statutory numbers, which I can give anybody if you want to call me on the phone or send me an email, can be included as a medical expense and added to your other medical expenses. And if the total of those medical expenses exceeds 7.5% of your adjusted gross income or the couple's adjusted gross income, then the excess can be deductible. But my guess is that most people who buy long-term care insurance also have health insurance. And so the likelihood of their exceeding 7.5% of adjusted gross income is not very great. So in most cases, I do not believe most people would get a deduction. However, you may find that a lot of your clients have an interest in a business. Certainly if they're a professional, they're practicing medicine, law, or whatever, they have a business interest, and it could be a C corporation. Many of them are. And if it is a C corporation and they are then employees, the entire premium, 100% of it, not the amounts limited by the statute, but 100% of the actual premium can be deducted and will not be taxed through to the client. And that can include the premium for a spouse. I didn't give this as an example, but it can be very useful. With that scenario, instead of paying for a lifetime, you might want to arrange a short pay, a 10-pay, or a paid up at age 65, which will give you a bigger deduction and will make it easier on the client once retirement occurs. If it's any other kind of a business entity, which is a pass-through entity for tax purposes, the statutory amounts that I referred to earlier can be deducted, and that's all. But again, if there is a business that can pay the premium, there will be some tax deduction, and that's something very much to keep in mind because it can certainly help pay the cost. As I mentioned earlier, an existing annuity can be the tax-favored source of premium dollars today, another way of paying for that, through the Section 1035 partial exchanges that I mentioned earlier. Let's move on now to the second area where we're going to try to equip you to make some wonderful sales. And this is a life insurance policy with a long-term care rider, which of course creates a package that has both death benefit protection and can give protection against long-term care expenses. Let's look here at a guaranteed universal life policy with a long-term care rider to see what kind of a benefit package we can put together. As I mentioned, there are two carriers, John Hancock and Nationwide. Others are beginning to look at it. There may even be some that have some variation, but those are the two primary ones. So let's assume we're dealing with a 55-year-old male. He's a preferred non-smoker, and like so many other people, wants some permanent protection for his wife. It could be the other way around. It could be a wife wanting it for the husband. But again, looking at real experience, and I've been around long enough to have witnessed this, if men only have term insurance on their lives, which they took out, whether it was to provide for their children while the children were very young, or to cover their mortgage, or just until they retired, or whatever, once they get to that point where that term insurance is going to disappear, the wives turn out not to be very happy. And I've heard more than one of them say to their husband, "You mean that insurance that you've been carrying, I'm not going to get that anymore? That's terrible. You never told me that." So this is one way that you can avoid that scenario, which very frankly could cause some serious marital problems. And in today's world, we don't need anything that's going to cause more marital problems. So let's again go back to the facts here. A 55-year-old male, good health. He wants this tax-free cash for his wife at death, but he's also concerned about long-term care protection for himself. In this example, it happened to be a real case. The wife already had some long-term care coverage from where she worked. Wasn't an ideal package, but it was pretty good, and the husband was not included in it. So the solution that we came up with here, and you might want to consider this for your clients who are in similar situations, was a $750,000 carrier guaranteed, so the secondary guarantee, John Hancock Universal Life Policy. And of course, John Hancock's ratings are way up there, so that there's a lot of security to their guarantee for this kind of a policy. This example case was $750,000. It could be less. It could be more. Now, just to see how much little the long-term care protection adds to the cost of this policy, I ran the illustration, and this was the way it was done originally, under three different scenarios. The first one was just a straight policy, no long-term care rider. And as you can see, the premium came out to be $9,278. I then added a 1% long-term care rider. And the John Hancock policy offers three percentages, 1, 2, and 4. And those percentages apply to the face amount of the policy. So a 1% rider on a $750,000 policy provides a $7,500 per month long-term care benefit. That is a flat benefit. It is not indexed for inflation on this contract. That's not available. The maximum benefit, of course, is the face amount of the policy, $750,000. And if it's all used up, there's still a residual death benefit they will always pay of $25,000. Now, to add that rather valuable long-term care production only adds about $500 to the premium. And the reason it doesn't add more is that John Hancock, in this case, is not on the hook for any more money. They're still only on the hook, basically, for $750,000. The only thing they might experience is that they have to pay it out sooner for long-term care coverage, and that's really why the premium goes up at all. There is a second rider that Hancock offers, which I find very attractive, which is a long-term care continuation rider. And basically, if you elect that, it doubles the potential long-term care benefits. Doesn't double the death benefit, only the long-term care benefit. So now you can collect as much as $1,500,000 under this policy. And with that rider added on top of the 1% rider, the premium comes out to be $10,335. Less than $600 more than without it. So I think these are both very attractive benefits. Now, just one comment. If we had picked a 2% rider here, which would provide up to $1,500 a month, it would still only be a $750,000 maximum, but the Hancock realizes that they may have to pay out the money sooner, more rapidly. So that would increase the premium. It would also increase the premium quite a bit for the benefit that doubles the long-term care benefits. Because the more of the $750,000 you pay out each month, the quicker it gets used up, the more likely you are to exceed it. So the most attractive package, premium-wise, is the one that I've demonstrated here. Of course, if you have a smaller face amount policy, you may have to go to a 2% rider, or in some cases even a 4% rider, in order to get a decent benefit. But I think this is an extremely attractive package. Now, one thing we have to recognize is that if, in fact, the long-term benefits are used during lifetime, the death benefit will decrease, perhaps be eliminated altogether except for the remaining $25,000, but the couple's assets will be preserved. So the net effect is more money for the wife, ultimately, one way or the other. A wonderful package, and there have been many sales made of that. The final idea we'll look at is a hybrid life and long-term care combination product. And this is ideal in certain situations. One of them is where there's an old, in-force life insurance policy that's not needed at all. And we're finding, as people get older, some policies that were bought when they were very young really might not be needed anymore. Maybe the premium has become too expensive, they don't want to maintain it, or whatever. If that policy is a whole life policy, as the example we're going to use, and a lot of those old policies were whole life, their premiums, their cash value will be quite a bit higher. And policies with high cash values are very poor candidates for the life settlement market. So a person who has one of these policies really only has one option if they don't want it anymore. and that is to surrender the policy to the insurance company. But that can often result in a taxable gain. Let's look at what that might be. Let's assume the value of this policy is $100,000. I need to make a side comment relating to that because that no longer means cash value, especially with the types of policies that have come on the market recently where the cash value might not be very large. The value is generally meant to be the interpolated terminal reserve, which is something you need to find out from the insurance company. It's very difficult sometimes to determine exactly what the value of an in-force policy is. In fact, at this year's conference of the National Association of Estate Planners and Counsels, I happen to be a board member, one of our sessions will be put on by a woman from Prudential, Terry Getman, and the whole subject is how do you value life insurance policies today? A strong cash value policy, the cash value and the interpolated terminal reserve are likely to be quite close. But let's just deal with what I've assumed are the facts here. And again, that we have a policy that's worth $100,000. Let's assume further that the cost basis of that policy, which would be the premiums paid, is $60,000. And the final assumption is that this particular client's federal and state tax bracket for income tax purposes is 35%. So let's see what would happen if this policy was surrendered to the life insurance company. First of all, there would be a taxable gain, and that is the value of the policy minus its cost basis. So there'd be a taxable gain here of $40,000. It's a gain, but it's not taxed as a long-term capital gain. It's taxed as ordinary income. So the tax rate would be the 35%, and that tax would come out to be $14,000. I don't think most people would be very happy paying $14,000 just because they didn't want their policy anymore. So the alternative is to do a 1035 exchange of that policy into a hybrid policy that has some life benefits, some long-term care benefits, and cash value, a very attractive package. And this, again, goes along with people who say, well, I don't want to lose all of this money. I want to make sure somebody gets at least the amount of money I'm paying into this contract. And so let's assume here a 63-year-old female, happens to be a healthy smoker in this case, has an unneeded $250,000 whole life policy with $100,000 of cash value. She wants the long-term care protection, but she always wants someone to get the cash. Let's propose this solution. It does a Section 1035 tax-free rollover of the cash from the whole life policy into a Lincoln Money Guard Reserve policy, providing maximum level benefits. That's our first assumption. And I just went on the computer, and this happens to be a real-life case I ran very recently, and saw what the benefits that were available, and I went for maximum benefits but level. In other words, no increase in benefits. And here's how it came out. The surrender value, if no benefits are used, starts at $100,000 and stays that way until the 10th year, at which time it starts to grow gradually until the 19th year, grows to a maximum of just over $111,000, and then drops back in the 26th year to $100,000 and stays there for the balance of the policy. I'm not an actuary. I can't tell you why that particular figure grows in the meantime, but I don't argue with the computer results either. The death benefit here starts at $208,482. Now, that's not the full $250,000, but remember that this person really didn't care about the life insurance. But this just means if she dies, someone will get that money. And that figure drops gradually, and I think I know why, because that's when the long-term care benefits could start to kick in more and more likely. But that drops gradually until the 10th year, at which time it levels off at $165,000. So that's always there as a death benefit to the extent long-term care benefits are not used. With this scenario, what came out was a monthly long-term care benefit forever of $4,588, up to a maximum of $385,000 and change. And again, those figures are locked in level figures. They do not change.